Most business owners think their tax year is fixed, January to December. That's just how it is, right? But not exactly, because what most people don't realize is the IRS actually allows you to change your company's tax year. And in the right situation, that one decision can unlock a series of tax planning opportunities. Hi, my name is Mia Taylor. I'm an enrolled agent and tax advisor. And this is one of those strategies that doesn't often get talked about. And it's not because it's complicated, because it's not. But most advisors aren't proactively planning at this level. So let's break down what the IRS actually allows and how this really works. So by default, most C corporations operate on a calendar year. That would be January through December. But under the Internal Revenue Code and IRS procedures, corporations are allowed to adopt or change their tax year. And to do this, they would file Form 1128, application to adopt, change, or retain a tax year. Now here's where it gets pretty interesting. In many cases, the IRS provides automatic approval. As long as you haven't changed your tax year within the last 48 months and you meet specific eligibility requirements. If you don't qualify automatically, you can still apply, but here is where you have to demonstrate a valid business purpose, okay? So why would you even consider this? Because changing your tax year changes when you recognize income, and that creates leverage. You may be able to defer income into a later tax period, better match revenue with expenses, smooth out fluctuations in your business, which ultimately gives you more control over cash flow, tax liability timing, and overall planning strategy. For high-income business owners, that level of control is everything. Now, let's ground this, because this is not a set it and forget it strategy. When you change your tax year, the IRS requires a short period tax return, meaning you close your books early and report income for a shortened period, okay? Timing is very critical. If Form 1128 is filed incorrectly, filed late, or missing required details, the IRS can deny the request. Also, not every corporation qualifies for automatic approval. Certain entities, such as personal service corporations or those tied to pass-through ownership structures, may face additional restrictions, okay? This is where real tax strategy separates itself from basic tax prep, because this isn't about changing a date on paper. It's about controlling when your income hits your tax return. And once you understand that, you stop reacting to taxes and you start engineering your outcome. Okay. Now, if you're a business owner whose income fluctuates year to year, or you're looking for more control over how and when you're taxed, this is a conversation worth having. Okay. At our firm, we don't just file tax returns. We build strategies around timing, structure, and control, and based on what the IRS actually allows. Okay, that's very important. If you want to explore whether changing your tax year makes sense for your situation, then I'll say like, share, and subscribe, and share this video. All right, and in the comment section, type in year. Okay, we'll go back and read those comments. All right, and then we'll reach out to you individually. All right, take care. Thank you for watching this video.